The AI startup market isn't just growing, it's redefining the rules of technology investment. But here's the paradox. Half of these companies make no money, yet command 33% higher valuations. In Q1 2025 alone, AI startups captured a staggering 58% of all venture capital. This isn't niche. The money pouring in is creating a new class of companies at an unprecedented speed. So, is this a bubble or the new reality? We'll break down the data, the drivers, and the dangers. The total market is projected to triple, hitting over $800 billion by 2030. Venture funding validates this, topping $100 billion in 2024, an 80% jump in just 1 year. This fire hose of cash has minted over 150 AI unicorns, companies valued at over $1 billion. It's not just unicorns. There are over 1,000 funded AI startups, potentially 5,000 with an AI angle. The scale is massive, but why are these companies valued so differently from everything else? It's called the AI premium. On average, AI companies command valuations 3.2 times higher than traditional tech firms. For the top quartile, this premium skyrockets. The best-performing AI firms command a 217% valuation premium over their non-AI counterparts. This is most visible in revenue multiples. A public software firm trades at 6x revenue. AI startups get a median of 25 to 30x. Why pay so much? The growth is real. AI companies are growing their revenue 1.5 to 1.8 times faster than their non-AI peers. Faster growth makes sense. But how do you explain the premium for companies with zero revenue? What are investors actually buying? Look at the top of the market. OpenAI's Q1 2025 funding round. They raised $40 billion, valuing the company at nearly $300 billion. But this isn't just for giants. Early startups are raising $8 to $15 million at valuations over $50 million in their first major round. The numbers are astronomical at every level. This brings us back to the core question. What happens when the promise meets reality? The answer is that investors aren't buying profits. They're buying potential, proprietary technology, unique datasets, and the talent to execute. But here's the first crack in the foundation. The exits don't always match the hype. Many AI startups, despite huge funding, deliver modest returns. This sustainability question is compounded by other risks. First, the immense cost of computer power and specialized talent. Second, rapid obsolescence, where a new model can make your entire tech stack irrelevant overnight. And third, the looming threat of regulation around data privacy and algorithmic bias. So we have huge valuations and investment, but also questionable returns and serious structural risks. How do these two sides connect? This is the central tension of the market. That 217% valuation premium we saw earlier, it directly collides with the reality of those modest exit returns. This creates a sustainability paradox. Private valuations are outpacing what the public market can currently support. Someone may be left holding the bag, and that flood of capital from the beginning? It's chasing potential. But high costs mean the runway to realize that potential is incredibly expensive. Finally, with up to 5,000 companies in the race, competition is brutal. This intensifies the pressure to spend capital quickly. So, what does this all mean for investors, founders, and the future of the industry? The conclusion isn't simple. On one hand, the growth is undeniable, and the massive investment is accelerating genuine innovation. On the other hand, the market shows classic signs of overheating. Valuations are detached from fundamentals, and the path to profitability is unclear. The AI market isn't a simple bubble. It's a high-stakes recalibration of value. Success requires navigating the chasm between potential and profit. The question isn't if AI will change the world, but which of these thousands of companies will survive to lead that change? What do you think is the biggest risk facing these startups? The competition, the burn rate, or something else? Let us know below.